Should I fix my interest rate? It's one of the most common questions that we get asked over and over. And in the last couple of weeks, with 4 and 5 year fixed interest rates starting to increase, we're finding that it is something that our clients are definitely wanting to understand whether that's the right option for them. The thought process as well too, and some of the commentary that's happening is that the 1 to 3 year fixed interest rates are also going to start to find their way up. And with the 3 year fixed interest rate being one of the most preferred terms for fixed rates, we thought at time we'd have a chat to you about the pros and cons associated with fixing your interest rate. Okay, so the thought that 1 to 3 year fixed interest rates may start to follow the 4 to 5 is primarily for two reasons. The first one is what's known as a term funding facility. This term funding facility was provided by the Australian government to the major banks, and what it was a big bucket of money, billions of dollars, that the banks could go and borrow at super cheap rates, and they could borrow it at that rate for a 3 year period. So what it meant was the banks could turn around and they could go and then on-lend that money to borrowers like you and I at cheap rates. The whole reason behind it was because the government wanted to ensure that credit was still readily available whilst we were going through this COVID situation. They wanted to make sure that the banks kept their doors open and made borrowing and interest rates still really affordable. Now that term funding facility, that shuts off 30 June. So the billions of cheap bucks is no longer going to be available to banks, and their funding costs are expected to go up a little bit. That's what so that leads to them potentially increasing the rates through to us as borrowers. The other part to it is that the global economy and the local economy, everyone's starting to bounce back. So what we are seeing in the general, however, is a feeling that the economy is picking up, and when the economy picks up, the Reserve Bank wants to ensure that they can keep inflation, so the cost of goods, relatively stable. So one way that they go about doing that is to start to put interest rates up. So primarily they're the two reasons why we're starting to see that 1 to 3 year fixed interest rates might start to make their way up. Is now the right time to fix your interest rate? Well, it depends on why you're wanting to do it. If, like most people, sit there and go, I want to fix my interest rate because I want to save myself some money, well, that's always fraught with danger. Yes, fixed rates have sat below the variable rate for some time now. Are they going to continue to stay below the variable rate? I'm not sure. What I do know is at the end of the day that variable rates, there's not a lot of scope for variable rates to reduce much lower than where they are at the moment. If they are to drop back away, there might have to be another COVID outbreak, or banks would be turning around and they'd be saying, you know what, well, the cash rate's not reducing, but we're just going to reduce our rates anyway because we want some market share. Why do I say that? Well, variable rates at the moment are still sitting anywhere up to 0.5% above the fixed interest rates. So should you fix your interest rate because you're trying to save some money? Well, you might. But at the end of the day, it's not going to necessarily change your world. Our golden rule around fixing your interest rate, regardless of, I suppose, what's going on in the markets, is you need to be doing it first and foremost because you want the certainty of repayment. That needs to be your starting point. And if you save some bucks along the way, then great. In terms of jumping into a fixed interest rate, it's not as simple as just turning around and going, yeah, okay, I think I might save myself some bucks, or yeah, the certainty of repayment is important. There are also two other key things that you need to consider. So with a fixed interest rate facility, predominantly, or the majority of them, have some form of restrictions. So what I mean by that is there's normally restrictions on how much extra you can pay into your mortgage. Now, if you're fixing your interest rate because you also want to save a few bucks, if you're restricted with how much extra you can pay in, that might negate the benefit associated with a lower fixed rate, because the best way to save interest is to pay extra in. The restrictions, so what type of restrictions? So because interest rates are low, if you can pay a lot more than the minimum, you might not be best off. You might hit those caps with respect to the amount extra that you can pay in. And if you hit those caps, then they can charge you a fee for it. So the first thing you need to think about is, okay, what's my repayment going to be on the fixed rate, and what's my maximum? And am I going to go over the cap and be penalised? So that's the first thing you need to think about. The other thing you need to think about is that with fixed interest rates, that extra money that you're paying into the loan facility, more often than not, lenders will have restrictions with respect to you being able to grab it back out. So even if you've got a redraw facility on your loan, if you pay an extra $5,000 in on a fixed rate loan facility, a lot of lenders will not let you grab that back out. So you need to sit there and think over that fixed rate period not only how much extra can I pay in, but is there a chance or a likelihood that I'm going to need to grab it back out? And if they are two things that you sit there and go, oh yeah, no, okay, so that's tick for me, that's tick for me, they're things that I need to think about, then what you need to think about is there an alternative way in which you can reduce the amount of interest that you have to pay while still having a fixed interest rate? I encourage you to have a chat to our credit advisors and to call our office, because one of the unique offerings that we have as a lender is our Finance Path Premium fixed rate loan. Both of those problems are solved basically with our premium fixed rate home loan. It'll give you the certainty of repayment that you're looking for, but the flexibility to pay extra in to be able to save your interest.